Well, hello. Good evening. Welcome. Great to have you on board. And this is in pre-show at the moment. Good number on already, and enjoyed some of the pre-show chat tonight as well. Some really good points being made. So good to see everybody there. And yeah, Donna, good point. Thank you very much for making sure that, please like the show, folks. Please like the show. And very important because it does help to propagate the news further. And smooth operator, yep, all good to go. We'll get this we'll get this off in the main show. So great to get that sorted out. And thanks, Smooth, to see you on board there. Sunshine Girl, hi, how you going? Good to see you there. And lots of other interesting questions, and also some interesting discussions as well. A lot going on. I'm just going to run this for another minute or so, just to let people catch in. Sonia, great, thank you. Good to know that you like the show. That's great. Vanessa, how you going? Please, great, thank you very much. Please like, indeed. That's great. That really does help. The point is that the interaction on the channel actually helps the YouTube algorithm to propagate it more broadly, which of course is what we need and want. Because I spend quite a lot of time and energy on these shows, and I want the information to be spread as widely as possible. And I've got a list of postcodes already. We will be looking at some of those a bit later. Still be time for that, and I'll talk in a second about the trivia, which Smooth is going to work with me on, so that'll be fun. Thank you very much, Michael. Great to know that. And what's nice, I've had a few people say how much they value what we do here, and that's great to see and to know that we make a difference. Matthew's talking about the Darwin market. Yeah, I think it's time to talk about Darwin in more detail. Probably not tonight, but maybe we'll do a show subsequent on Darwin. And there we go, there's that one. And Cookie Boy's asking about commercial property. Yeah, Vanessa, I'm good. I hope you are too. And the new voice says 3036. All right, I'll add it to the list. 3036. Got a long list. Okay, well, I think that's enough pre-waffle. So let's pre-chat waffle, I should say. Let's take that off. And then I'll just run the introduction and then we'll get going properly. So stand by. Well, good evening and welcome to this live stream event on the 1st of January 2021. Martin North from Digital Finance Analytics here. Great to have you on board. And we're going to go through a lot of quite detailed information tonight, but also hopefully have a bit of fun on the way through. And appreciate all the comments. Blurred Squid says, I'm back. Great. Welcome. And RCC says, always like to catch a live show when I can. Solid work. Thank you. Appreciate that. Yeah, there's something about being involved in the live rather than just the replay. The replay is good, though. You know, it's worth it's worth catching if you don't get the live. And I'm just making a bit of a note of some of these other postcodes that people are asking about. I've probably already got a list longer than my arm, but that's okay. We'll try and get to them. Just as normal, I want to just take you through some of the normal introductory stuff first. And the reason for that is that I just know that there are a few people who perhaps have not been on one of these streams before and won't necessarily know what we're at. So it's important that people get to understand a bit more about that. So that's what we're going to try and do. And I'm going to start with the running order just in terms of this introduction. Then once we've got the introduction sorted out, we'll go through the house rules, we'll talk about our models, we'll run some key slides and just give you some context and background for the discussion. Then the major part of the show will be questions and answers, and we typically run for about an hour and a half or so. And through that, we'll be able to get into some quite detailed areas, but shaped by what you want to ask about, really. And then we'll sign off at the end, so that's how it goes. And in terms of house rules, I always say this, but I just want to make quite sure that you all understand. We don't offer financial advice here. Financial advice requires to understand individual personal circumstances. We can't do that. So what we do here is essentially just discuss the principles and also some of the main analysis that we've been doing based on what we've been looking at. Do play nice in the chat room. It is moderated. No racial slurs, please. And this is out at the 1st of June 2021 if you're watching this in replay. Also, use @WalkTheWorld if you want to get my attention, specifically if you want to ask a question, because there's always loads of stuff going on in the chat. I don't necessarily get across all of it, simply because there's just way too much. And we've also enabled Super Chat, which allows you to do a couple of things. The first is to make a contribution if you'd like to do that, to help run the shows that we make here. We don't do this for profit. We do this because we think it's important. But also, if you want to get your question to the top of the list, you can also use Super Chat for that. Now, just in terms of our core models, for those who haven't come here before, we survey households all the time, 52,000 households through the year. And that information then goes into our core market models and essentially drives everything we do, including our conversations on YouTube and our other stuff on the blog. And we can cut the data and slice it and dice it different ways. We look at different locations, different types of people through our segmentation models, and all sorts of things like that. It's like a Rubik's Cube, as I often say. And that also allows us then to think about how that translates into different scenarios. And we'll talk about scenarios a bit later. Some people often sort of seem to think that I basically only have, bearish thoughts around property. That's not true. I actually run multiple scenarios. And for the last 9 months or so, there has been a positive set of scenarios. And Cookie Boy actually sent me some historical artifacts earlier on relating to what NAB said just a few months ago, sort of last year. And in some cases, they were talking about prices going down 7% this year and last year as well. And of course, CBA a few months ago, middle of the pandemic, was talking about prices 32% down. So, everybody has some different views. I run scenarios, and the reason I run scenarios is that it's too uncertain to be precise about precisely how this is going to play out. So we'll talk about scenarios again down the track. Now, in terms of that, what it also means is I can take my core market model and look at the stress data, the price trajectory data, the buying and selling intentions, migration data, the economic data, bang it through the core market model, which is my analytic engine, and then at a postcode level, at a rolled up level, a region, state, or all Australia level, I can then make some estimations about what home prices are doing. And we'll be talking about our price engine and stress engine shortly and share some information on that. Now, let me just turn to the DFA 1-to-1. The reason I'm doing this here is because tonight I'm going to offer one free session for one viewer who would like to participate on the DFA 1-to-1. Now, the DFA 1-to-1, what is it? Well, it's essentially a conversation about an individual suburb. And I can't give specific financial advice, but I can analyse data around a particular suburb within a postcode and look at the underlying trends, and I can talk about stress and home prices and the other issues that are going on. I, of course, made a few shows over the months from the output of the 1-to-1. You can book a time, normally for me, about an hour is typically what we spend talking together. And normally that would be $250 plus GST, payable in advance, but there's a 3 to 5 week delay at the moment because I've got so many on. But I am going to offer tonight, one lucky person is going to have the opportunity to get a 1-for-1 conversation free. Now, to make that work, there are two things. The first is that we're going to pose, in fact, Smooth Operator is going to pose a trivial question, or I should say a trivia question, because it's not really a trivial question, a trivia question a bit later. And What we will then do is we will get people to answer the question, and to be eligible to go into the draw to get the one-to-one for free. The way it goes is like this. You need to actually answer the trivia question from Smooth Operator, and that question needs to be the right answer. Now, we won't necessarily declare early on what the right answer is, even if somebody says the right answer. We're going to let this run till 9 o'clock, and then what we will do is tell you what the right answer is. And the other thing is that we would like to encourage you, when you put your answer in, to make a contribution via the Super Chat to help cover the costs of running the channel. So, you know, that's the model of what we're going to do. So essentially, when Smooth Operator sets the question up shortly, you've then got up till 9 o'clock to put your answer in, and then I'll go back over the chat after the show, pull out all the answers that were correct. I'll then run them through a draw, and tomorrow night in the show then I will announce the winner of the person who gets a free go of a DFA one-to-one. Okay, so that's how we're going to do it. Should be fun, and good luck to everybody, and I'll let Smooth pick the moment to put the trivial question up. As I say, we won't tell you necessarily straight away whether you got the right answer or the wrong answer, so people can answer multiple times and, you know, put different answers in. But at 9 o'clock we will then announce what the true answer is, and then people can judge whether they could be in the running for the draw. And as I say, encouraging you to put a contribution in via Super Chat when you put your answer in. Okay, so that's that. Now let me go on with my presentation, just to say that the RBA held again, no surprise at all, absolutely no surprise. The GDP is forecast to grow by 4.75% this year and 3.5% over 2022, supported by fiscal measures, blah, 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 the same sort of stuff, so nothing really new there. Progress in reducing unemployment has been faster than expected, they said, unemployment rate declining to 5.5%. Now, of course, that is on the official ABS number. The true number is somewhat higher because there are still lots of people not looking for work, and in fact the participation rate came back a bit. Job vacancies are high, that's true, and they're expecting a 5% unemployment rate by the end of this year. We will see, and we will also see whether those labour shortages are real. Of course, the lockdown in Victoria, and sympathy to everybody in the state of Victoria and in Melbourne, that may have an impact as well. And then they went on to say that despite the recovery in the economy, etc., wage pressure is subdued. The pick-up inflation and wages growth is expected. It's likely to be gradual and modest. Central scenario inflation in underlying terms is expected to be 1.5% in 21, 2% by mid-2023, although there is the possibility in the short term of a temporary rise to above 3% in the June quarter because of the reversal of some COVID-19 related price reductions. So this is very similar to Jerome Powell's temporary transitory issues, not real underlying inflation. And of course, one of the key points I have to make is that underlying inflation and full inflation isn't necessarily capturing everything. Costs of houses, for example, not really in the numbers at all. So that's a little bit one-sided, but nevertheless, that's what they're saying. And, when you actually take that back, they went on to say, well, housing markets have strengthened further. It's important that lending standards are maintained. Well, I can tell you that my research has shown that lending standards are being loosened. People are getting bigger loans. Average first-time buyer loan is now 15% bigger than it was a year plus ago. And we're seeing more interest-only loans, and we're seeing more investment loans all being made at the moment. So the banks are having a field day. And of course, NAB, for example, discounted their their investment loan to try and pull some of that through before it all gets a bit tighter later in the year. So I'm afraid the banks are already reducing their lending standards. And of course, the other point to make there is that in June, the removal of the responsible lending legislation is going to come back into Parliament. Frydenberg still wanting to put it in on the ostensibly argued position that we need even greater lending. No, we don't. We've got plenty of lending. And as I've discussed a few times, credit creation is all about simply creating more and more and more credit. That is leading to more and more debt. That debt, of course, has to be repaid at some point, and we've got some of the highest indebted households, businesses, And government, of course, debt as well is pretty high. And of course, some of our corporates have borrowed internationally, and so that they have also a considerable exposure internationally too. So this is a big deal. They also made the point that next month they're going to look at whether to retain the 2024 bond as the target or move it out. This is all about yield control. They've been manipulating the yield curves, of course, for the last few months, and particularly the 3-year rate and below. And they basically are saying, well, we'll look at it, but we'll wait and see. They're going to continue to do the bond purchases and continues to place a high priority on a return to full employment. So in other words, never mind interest rates, never mind credit. Doesn't matter if credit continues to blossom, because it's all about full employment, lower unemployment rates. And that, of course, is the latest excuse they've got for doing what they're doing. By the way, the Fed's aping the same thing, or I'm not sure who's copying who, but they're talking about the same as well. They also made the point that the term funding facility, which is the very cheap money for the banks, is going to end at the 30th of June. So far, they've drawn $134 billion from the facility. There's a further $75 billion available. And that means that the banks have got very, very low cost funding for the next 3 years. And that will continue to support low borrowing costs until mid-2024. Of course, the banks, though, will have to drive their funding from other sources beyond that, and that includes probably trying to get more term deposits from savers, and also accessing international financial markets. Those returns will be higher than the 0.1%, so that's going to put upward pressure on bank margins. And in fact, I did a show today with one of the analysts at Mozo talking about the upward pressure now on interest rates, not from the cash rate movement from the Reserve Bank, but from market dynamics, because of the term funding facility beginning to end, because of the fact that deposit rates are beginning to rise just a little bit at the moment, and we're also seeing some of the really cheap mortgages that were available disappearing as well. So margin compression and margin contention is going to be one of those very significant issues ahead, and that's going to put pressure on the banks, of course. And the way that the banks are handling at the moment is they're trying to suck in as much cheap money and make as many loans as they can to build their book as quickly as they can ahead of the tightening, which is going to come later in the year. And the last point they made was that the whole strategy is to try and generate wages growth. It's unlikely, though, that it's going to be materially higher than currently until 2024 at the earliest. In other words, folks, don't expect a pay rise above inflation. We are in this for the long haul. And what that basically means is that there's no get out of jail card. Back in the early 2000s, if you look at what happened, there was a lot of growth in lending, but also mortgages was more serviceable because people had they had income growth much higher than price rises. And that meant that they were able to get out of jail. There's no get out of jail card. This time around, income growth is going to be static in real terms. It's been static for many people since 2011, 2012. And what that basically means is that there is no wriggle room. So if you commit yourself to a really big loan, you could definitely be under the pump if rates start to rise, or if the employment situation goes off the boil. And of course, we do have the lockdown in Victoria now to contend with as well, which we'll talk about in a second. Now, just in terms of the financial aggregates, I made a show on this yesterday, so I won't do it in detail, but it is worth noting that the total growth in credit was very low. April 2021 for the year, 1.3% compared with 3.5% last year. Business credit is down 3% analysed, and housing credit is up 4.4%. So housing credit is higher, and you can look at that on this chart. This is actually the overall housing up 4.39% annualised. Owner-occupied credit up 6.23% and is getting quite high now. Investment lending is also moving up at 1.3% annualised, so that's quite a change from a few months ago, but of course still way, way down from where we were in 2015 and 16 before APRA turned the taps a bit tighter. And personal credit down 7.79%. Now, that's still down from where it was, but of course that doesn't include buy now, pay later, which is not regarded as a credit product according to the Reserve Bank, does not require responsible lending obligations on it. So it's another great backdoor way of stoking the economy without actually have to report the credit. And business credit down 2.98%, in other words, pretty much 3% over the year. That's a really bad issue, because what that means is that essentially businesses are not borrowing, and without the businesses borrowing, we are not going to see significant momentum in the economy. Housing is not the same as growing the overall economy. RBA, please note. Treasury, please note. And by the way, just in terms of the credit aggregates, overall credit up 1.25% over the last 12 months. Broad money down now to 6.75, and of course that's because we had those big stimulus packages there, which are now working out the system. So, and it's very interesting to see that divergence between broad money and the credit momentum. Now, across the banks, this is another chart from last night. It's very interesting to see that CBA and Westpac and Macquarie are all driving very firmly on both investor and owner-occupied lending. NAB is doing owner-occupied, but its investment portfolio has gone backwards. One reason why I think they discounted their interest rates on variable investment loans. And then you can see some of the smaller players, ANZ, some gone a little bit backwards. Now, of course, the thing to highlight about these particular charts is this is a net position, and it doesn't include any securitization that may be underway. So if the bank actually takes loans off its balance sheet through securitization, they disappear out of the APRA statistics. So this does not give you a very good read necessarily on precisely what's happening, but it's nevertheless quite interesting, and it highlights the different strategies between the different lenders. Not all of them are doing the same thing, as you can see there, but interestingly, some of the smaller banks are also quite active in terms of their lending strategies at the moment. Now, if I look at some statistics from the chart pack, this came out the other day from the RBA. It's very interesting to notice that whilst the growth for owner-occupied lending is, reasonably strong, still a bit lower than where it used to be, but investor lending is still way, way down from where it was. So, let's not get carried away with the news that investment lending is booming. It's not really. It's just moving up a little bit from where it was, from a very, very low base. And it's also worth noting that they also show that housing and business and personal lending, it's a bit like what I just showed you. It really is a problem. Business lending is falling away. Personal is moving up from a very low base, but is still negative, so it's not falling as much as it was. It's all housing. So basically, all of the eggs are in the housing sector lending basket. And it's interesting that UBS published some research today that made the point that the record low public sector wages are weighing on total wage index. And they do expect to see some bounce back, particularly in public sector wages over the next couple of years, maybe less in the private sector. Private sector has tended to languish for a long time. And they also make the point that the wages have slowed more in Australia than many major other economies. And, there might be things like wage freezes, etc., which could unwind. But if you look at Australia compared with the Eurozone, compared with the US, well, Australia is the bottom of the pack. So we are not getting income growth. We haven't had income growth since 2011, 2012 in real terms. And the prospect from the Reserve Bank is no change until 2024. So don't expect a pay rise anytime soon. Now, the other interesting data that came out today from Roy Morgan and ANZ Research is that there was a significant dip in confidence. It fell 3.8% in Melbourne, but actually was more sharply down in Brisbane, down 4.7%, and Sydney down 4.5%. Now, that's really important to understand. So we don't have just a sort of local crisis in Victoria or in Melbourne. This is actually hitting confidence nationally. And of course, it also is raising questions about travelling interstate, and it's raising questions about when the international borders will open. They're still saying middle of next year, could be later than that now. And, Roy Morgan did make the point, of course, the absence of JobKeeper for this episode means we need to be alert to worse results than experienced to date, because there are many people who are actually financially strapped, as we'll see shortly. And the latest lockdowns and the lack of JobKeeper is a real issue. I'm amazed that the federal government has not actually pulled the JobKeeper card back out on the table again for at least Victoria. They probably will have to if this goes on. But there are many people out of work now who are expecting to be in work, and many of those are living hand to mouth, and therefore it's a real issue. I'd also make the point that dwelling approvals came out today from ABS. The number of dwellings fell 8.6% in April in season adjusted terms. That, of course, was after a big rise in March. And it's interesting that private sector houses rose 4.6% in April. That's a new record of 15,063. Well, there you go. That's the result of all of the stimulus and, the homeland packages that were actually funded by government earlier on. Private sector dwellings excluding houses decreased 28.6% in April, driven by a large fall in improvement apartments in Victoria. And you can see there the bifurcation between the two. It's very important to understand that whilst the housing sector is being stoked by, government stimulus, the units are falling off a cliff. And I'm afraid that the units look to me to be continuing to languish for some time. And you can look across the interesting data by state there. Dwelling approvals rose in New South Wales up 12.3, with WA 5.5, South Australia 3.4. They fell in Victoria down 23.5, Queensland down 14.3, and Tasmania down 2.5. And private sector houses rose in New South Wales up 30%, Queensland 8.3%, South Australia 2.7%, and there were falls in Victoria down 5% and WA down 3.8%. So this is not a national story. This is different places around the country behaving in different ways. And so we shouldn't get too carried away by these statistics, which, by the way, are often a bit noisy in best of times. But, of course, the media release from the HIA conveniently just picked detached house building approvals and then celebrated that peak that I mentioned earlier on. They didn't really mention the units much at all, but of course, as I showed you, the unit sector is definitely in a different part of the spectrum when it comes to what's going on. Now, let's turn to my mortgage stress data. So firstly, the overall mortgage stress for May, so this is up till, a couple of days ago, really, was actually again at 41.1%. It went up very, very slightly compared with last month, but hardly at all. And the household debt to ratio is still 180.4. There's no new data from the Reserve Bank on that. So we can see there that we've got a lot of debt in the system and we've got a lot of mortgage stress. And mortgage stress compared with where we were in February at 32.9% is significantly higher. Now we can look at what that translates to, and I'm going to start with last month's. I want to draw your attention specifically to the situation with regards to the mortgage stress at 1.5, at 41.28, and rental stress at 1.7, which was 35.04, and investor stress, which was 25.94% or 846,000. So that's the starting point. If I then go to the May statistics, you can see there that the mortgage stress has hardly moved. It's 41.13, but the rental stress has gone up. So just to go back, 1.7 to 1.95, that's a significant hike in the number of people who are in rental stress. And we also see that in percentage terms, so from 35 to 38.24%. And if you look at the investor stress, in April it was 25.94, now it's 26.21, so that's a bit higher. And also the overall financial stress at 39.25% is up from 37.98%. So we are seeing the situation where, thanks to rental stress, as well as the mortgage investor stress, and those two things of course are linked, households are actually in worse shape in May than they were in April. And just in terms of that, I want to highlight three things. So rentals, a number of people are now not protected because they were essentially given protection from being forced to pay rents, or indeed any rent rises. Rent rises have been starting to flow through quite dramatically from investors. The second is that a number of renters have actually left to try and find cheaper accommodation elsewhere. And the third thing, that some of those renters are now being asked to pay a number of months in advance for the next place that they're renting. So that's one of the other factors in this research that we found. And what that basically means is that it's a very costly experience now for many renters to move and to try and find somewhere else, and yet they're being forced to, because in some cases property investors are now trying to sell their investment property because the rental returns are just pretty awful, while the capital appreciation is rising because of the investment property trajectory that's going on. And that means that many renters are really under the pump. Now, I'll be able to show you in more detail which postcodes are affected, but I'll just, before I do that, I'll just go back to the mortgage. There we go. Let's go to the mortgage stress. So this is the stress for top postcodes. So I've done it here sorted by the number of households who are in mortgage stress and the percentage of borrowing households that are actually in mortgage stress. Now, just to be clear, I define mortgage stress as money in, money out. How much money is coming into the household each month, how much is going out, including whether it's a rent payment or whether it's a mortgage payment, right? If they've actually got more money going out than coming in, they're classified as stressed. They can tap credit cards, they can pull down deposits, they can use buy now, pay later, whatever, right? And I would make the point, because I picked this up the other day, one or two people have been accusing me of double counting. In other words, if you put money on a credit card, that counts as two debts. No, it doesn't. It only counts as one transaction. So there's no double counting in my modelling. So I'm afraid that those people who are trying to criticise it as being inaccurate are completely wrong. So the postcode in the country with the highest mortgage stress is 6065, tapping. And there are 9,661 households in that WA postcode, 6065, 63.83%. Then we go to Victoria, to Narre Warren. In the high growth corridor again, there we've got 73% of households, and that's about 8,800. Then we go again to another Victorian postcode, Berwick Huckaway, that's 3806 at 84.6. Then we go to Sydenham in Victoria at 75% with another 7,700 households. Pakenham at 72.62%, that's postcode 3810. And then we go to Cranbourne. So there's a bunch of Victorian postcodes in that outer suburban ring. That's a big deal. Then we go across to WA again, and then we come back to Victoria, to Roxburgh Park, another one, and then we come back to New South Wales, and so it goes on. And then we go up to Queensland, so we've got Ipswich in the area around there with 62.86% or 5,700. Then we go to Camp Hill in Queensland, and then we're back down to Victoria and New South Wales. So these are the really stressed areas, and I'll show you some mapping shortly just to take that a bit further. But so that's the starting point for the mortgage stress series. Now let me run it through to the rental stress. So now this is those in rental stress. Remember I showed you that rental stress had gone up, right? So the postcode with the highest rental stress in terms of count of households is 2770, and that includes places like Lethbridge Park, and there are 9,218. Then we go to West Gosford, which is of course up in the Central Coast. People are surprised by this, but there's a lot of people there, 77.87% or 9,109 in postcode 2250. And then we go to the area here, which is again Jarvis Bay and places like that. Again, regional parts of New South Wales, but a very significant set of pressures with regard to renting. One of the things we've happened here is that rents are going up very much, very fast. And so there are more people struggling to be able to rent at all anything in some of these regional areas, and that's why the rental stress is rising. And I think it will continue for some time yet, partly because of the migration to regional areas and partly by the fact that the demand for property for rent is rising and therefore rents are going up there. It's very different when you look closer into the city, by the way. Then we go to Greystanes, places like Westmead, that's a 2145 with 67% there. Then we go to Queensland to Millbank, that includes a whole bunch of areas there, you can see them listed, but Bundaberg is the critical area. That is really where the centre of gravity is. So 48% of people in Bundaberg who are renting. Then we come to Bondi. So, Bondi Beach and Bondi, 72%. And that's a big deal. So a lot of people closer into the city are beginning to find it difficult. Then we go to Service Paradise. Again, a lot of migration up there, a lot of demand for rental accommodation. Prices are rising. And then we go to Cranbourne, Funny how the same ones pop up again. So Cranbourne 3977, 71.87%. And then we go to Blacktown in New South Wales at 73%. And then we come down to Wollongong at 66%. I'm seeing that locally in and around the Wollongong area. Again, same issues, regional prices rising, rents going up, local incomes not rising, significant pressure on households. And then we go to Ipswich again, and 55.8% around that area. And then we come to the Rocks and areas around that, New South Wales 2000, so even close into the city, and Darlinghurst and Surrey Hills, got issues there too, and down in Victoria, South Yarra. So wherever you look, we have significant pressure on rents. Then if I look at stressed investors, so these are property investors, and this is where they are residing. It's not necessarily where their property is, but often it's in the same area, but doesn't always apply. The one at the top is Melbourne, Victoria 3000 at 77.35. Of course, we have lots of issues there now with all the lockdowns, a lot of vacant properties. The vacancy rates in some areas of Melbourne, close in, are 15% and rising, and a lot of the new high-rise is unoccupied, so vacancies rates are very high, and unoccupied buildings are, very, very significant on the horizon there. Walk around certain parts of the centre of Melbourne at night, there's nothing going on, no lights on. And then if you look beyond that, we've got Greystanes or Wentworthville and Westmead at 46.58%. Then we've got Surfers Paradise, so some property investors are struggling to make this work, and that's a combination of costs arising and issues with rent. Of course, prices have risen dramatically up there as well, so that's another factor in the mix. And then we come to New South Wales around Barrow Bay, and then we come to St Kilda and then South Yarra, and then we go to Queensland, Rushcutters Bay, so 2011 areas around there. And so it goes on. And of course, good old Mandurah is still on the list, 6210, 30.53% of investors in difficulty. So relative to some of the others, it's not too bad, but it's still a big issue, and they're still actually seeing prices way off from where they were. And many investors are still underwater on a capital basis as well as a cash flow basis. And South Bank is also on the list. And again, it's the same issue that they can't let the properties, and therefore they've got issues. And where you see these high stress levels, what tends to happen is that people are starting now to put their properties on the market. So we're seeing more controlled listings of units coming onto the market. And that's one of the reasons why, whilst home prices for standalone houses are quite strong at the moment, the prices for units continue to slide in many areas. And in some of these high stressed areas, they are continuing to slide quite significantly, in some places 20 and 30%. So don't be deceived. Not all property prices for all types of property in all locations are buoyant. It is just not true. Okay, and then if I go to financial stress, this is the overall aggregated numbers. So the postcode at the top, 3000, Melbourne, at 79.82%. Then we go to Lethbridge Park in New South Wales, Cranbourne in Victoria, Greystanes, Wentworthville and Westmead. And then we go to Millbank and areas around there, including Bundaberg. Then we go back to Narre and far south, Hoppers Crossing, I always get that wrong, Hoppers Crossing, apologies, Ipswich, and so it goes on. And so this is the way of trying to understand what's really going on at a granular level. And that's why I keep saying you've got to understand stuff locally. You can't just talk about high-level averages and all the indices. And of course, they've all come out this month with massively high indices claiming everything is booming. Well, it's not. There are significant areas where prices are not doing the same as what people would expect them to be doing based on those high-level numbers. So go granular is my message. Now, let me just then quickly switch to stress mapping, because one of the most powerful ways of showing this is to show you the colour coding and the mapping that we do. And so each month, as you know, we actually do quite a lot of detailed geomapping. And so the blue means low stress, the orangey red means high stress. So if I pull out from New South Wales, Sydney, you can see as we pull out, we start to get a bit of a picture in terms of where those high stressed areas are. And in fact, typically, of course, it's Western Sydney where the issues are. You can see as we pull out, you can start to see the areas that are beginning to register in terms of high stress. Now, this is actually the count of households rather than the percentage, which I did last time. So this is the count of households. So the darkest colours mean more than 7,700 households in the particular area. And you can see there that relative to close in to the city, Western Sydney is where a lot of the issues are. Now, if I then do the same for, let's go to 3,000. Okay, so we're now going to look at Melbourne, same process, same coding. The bands stay the same. And so we pull out and we discover that, close in, there is some issues, but not dramatic. But when you start pulling out from the centre of Melbourne out, and you start to see the surrounding high growth corridors, then it all sort of gets quite clear. And you can see places like Narre Warren, it's down there, Berwick and Harkaway, the areas, of course, to the west of Melbourne as well, and to the north as well. So there's a surrounding area around the city that is really highly stressed in those high development areas and beyond. And in fact, if you pull out to regional Melbourne, Victoria, you can start seeing that places like, further out here, there are also registering as well. And so, again, you've got to go granular, right? You can't just sort of talk averages. You've got to look at individual areas. Now, if I then do the same for 4,000. So this is Brisbane, of course, in the area. Stress is not as bad here, but there are some areas where it's beginning to come to be a bit of an issue. You can see there north of the city. We're starting to see some of the darker colours. Not the same dramatic dark colours as we saw in and around Sydney or Melbourne. But as you pull out, you can begin to see Ipswich around there, the same sort of problems as I highlighted earlier on now in map format. And if you go out far enough, you can begin to see some very interesting and concerning areas. Nothing like the stress levels that we have in Sydney and Melbourne, but nevertheless, there are significant numbers and significant pockets where stress is quite high. Now, I'll just continue that journey of postcodes if I go to 5,000. Okay, so here's now 5,000, so around Adelaide. And once again, if we pull out, we can begin to see that the stress levels, not too bad in some areas, but as you go north, particularly of the city, you start seeing, and then it begins to get a little bit awkward further south as well. But Salisbury North, places like that, has always been the hotspot, and it continues to be the hotspot in and around Adelaide. If we then do the 6,000, so we're now over in the west, looking at Perth. And once again, as you pull out, you can see how the stress varies by locations. As you go north of Perth, you start seeing it. As you go south of Perth, you start seeing it. Some of those new high growth areas still registering as significantly stressed. And as you pull out further, you can see the patterns quite clearly. Now, what's quite interesting is that some of these stressed areas, the price rises are nothing like they are close into the city of Perth. So again, you've got to be very careful when you actually watch the information about Perth itself. It is not uniformly buoyant. And of course, if the iron ore situation falls over, and there's a chance it might, if China gets really cross with us, that could be a big issue for the West as well. And if we just quickly go to Tassie, you can see there that Tasmania has its own problems. The issue with Tassie, of course, is that prices are very high relative to incomes. And so we do see levels of stress, not dramatically so, but there are a number of areas where stress is definitely on the radar. Now, I could just do a little bit on rental stress, just for comparison purposes. And with all of those, the situation is, again, all about granularity. So let's start in Sydney. This is now looking at rental stress. And the picture's a bit different. You can see there that Bondi is actually registering. The city is also registering high levels of stress there compared with what we saw in the previous one. But as you pull out, you then start to see the same pattern with regard to the west. So you can begin to see that there's actually quite a lot of issues. Liverpool, places like that. It's all very much of a muchness. Campbelltown, and so it goes on. So issues in the west, but also pockets closer in. And that's pretty much repeated if you do 3,000, come down to Victoria. And just the same sort of scenario comes up again with levels of stress registering. Rental stress is a real issue, so even closer into town there's some, but as you go further out, look at this, the big swathes around Wyndham, 3029. And as you pull out further, you can see the same sort of things going on. So again, it's not surprising that financial stress overall is high, because you've got investors struggling, you've got renters struggling, and you've got people with mortgages struggling. And I'll just do one more. I'll just do the west. I don't have time to do all of the views for all of the postcodes. It's way too complicated to do, and we'd be here all night. But it is quite interesting just watching what's going on. So this is the rental stress. So rental stress in the west, not too much of an issue, although rents are going up quite fast. People are having to pay a lot more. People are being asked to pay for months and ahead to secure a particular location. So you can see there's a bit of pressure there. And as you go out further from the centre, the pressure rises, but it's not as severe as in the down the east coast. So there you go. That's a little bit about our stress mapping and what we've done there. It's a pretty important conversation, frankly, to get a sense of what's going on, and very importantly, where it might lead. I say to people, you need to understand, you really need to understand what it's like on the ground. You can't just talk about high-level averages. It doesn't tell you anything. Now, just before I finish this part of the presentation, our scenarios. I've explained already, I think, that scenarios are just a way of exploring different futures, different alternatives. I'm not saying it's going to be right, but it's quite interesting to see. And in fact, this month, there's been hardly any change to the scenario base, so there is still a significant probability of price rises. Somewhere between 25 to 35% is quite possible in some locations. Depends, of course, on units versus houses. But there is also this question of what happens if the virus keeps wobbling around, and if we get a longer-term crunch. Well, that could be a rather negative factor in things. And indeed, if we had a really severe wave nationally, prices could still fall. But at the moment, the probability is up here in the top area. I think the RBA is rather positive, too positive probably, but nevertheless, the fact of the matter is, it looks to me as though there is upside for property in the short term. I think later in the year, though, that may change. We'll see. I'll model this every month and update it each month. But, even if we have a rise of somewhere between 15 and 30% over the next 2 to 3 years, so I'm looking not just in 12 months but beyond, that would be very high. People will be in more debt, and of course more debt leads to more exposure, particularly if rates start to rise, and as I've highlighted earlier on, I expect rates to rise. So that's essentially a rather different scenario than many people are expecting. And so just to be clear, folks, property bear, property bull, well, I've got my different scenarios at the moment. I'm on the more bullish side of the scenario, but I'm also aware of the downside risks. And just to explain, this 80% one, this is a very unlikely probability at the moment. But if things really unwound, if we had a significant financial collapse, not just here, but in other places around the world, there is a significant downdraft to prices for property. Now, of course, in the UK and in the US, in global financial crisis terms, they were down 35 to 40%. So that is certainly feasible. In a really severe crisis, when essentially everything falls over, could be even more so. So I keep that one on the radar, but that's not a central case for me. I'm really looking at these three in the middle. Okay, so that's pretty much that. And now what I can do is just give you a little bit of an update and talk a little bit about the tool. And I will also give you just a little bit of demonstration of the tool. Let me just go here. Okay, so this is the tool that's now available. Anybody in our Patreon scheme at $50 a month can access this directly. And I'm just going to start by answering some of those from beforehand. So 4556 was the one that came up first. And if we go for 4556, it gives you a bit of a flavour of the way the model works. So this is the information that's available for every postcode. And essentially for 4556, that includes Sibby Downs and a few other places as well. 17,400 households, of which 7,000 borrowing and 7,000 are renting. There's around 5,000 properties for rent and about 6,000 renters. Overall financial stress is 35%. That's quite low relative to some other areas. Mild stress, 2,499. No severe stress, 36%. Default rates at 3%. And the rental stress, 28%. That's pretty low. And investor stress at 28%. So this is not a postcode that's in dire straits at the moment. And over 3 years, we are thinking best case scenario could be a price rise for houses of around 14%, for units about 10%. But if those less positive cases play out, in other words, if the virus comes back and we have to lock down for longer, then effectively the scenarios get negative. And over 3 years, worst case, down about 3 or 4% for houses and about 2.7% for units. So that's that one. And then there was another one at 4670. Whoops. 4670. As I say, this is all available now for if you want to sign up on the Patreon channel. You can get access to all this information anytime, and you can also make comparisons between different types of postcodes as well, which I'll show you that in a second. Okay, 4670. So this is a very long list of places, which I'm not going to read out, but Windermere's on the list. 36,000. Households, 11,000 borrowing, 16,000 renting, 12,000 renter properties, and 13,000 renters. 39% in financial stress, mild stress at 25%, 2,800. No severe stress, 4% defaults, a bit higher than some other areas. 49% in rental stress, getting a bit higher, and investor stress a bit higher at 31%. Overall, over 3 years, 14% for houses. 9.8% for units is my best case scenario over 3 years. Worst case scenario, fall of 4% over 3 years for houses and 3% for units. Okay, next one, 6101. This is Slackra. Oh, so this one, 6101. Look up. Okay. So this is Carlisle, East Victoria Park, that area. 7,700 households, 2,700 borrowing, 4,000 renting, 3,000 properties for rent, 2,100 renting, 43% financial stress. Just going to take a drink, excuse me a second. Mild mortgage stress, 1,200, 45%, that's a bit higher. 5% in default. We're seeing default rates in WA rising at the moment, actually, not falling. 30% in rental stress and 31% investors. And over 3 years, 9% rise for houses, best case, worst case down 9%. 6.6% for units, best case, 6.6 minus worst case. So that's that one. And I'll just do 6053 and then I'll stop and get some questions from the audience. 6053. Okay, 6053, which includes Bayswater. So 6,500 houses, 3,000 borrowing, 2,700 renting, just over 2,000 properties for rent, and rentals, well, 25% financial stress, 22% mortgage stress, 4% defaults, 21% in rental stress, and 28% in investor stress. So it's not a huge amount. So basically I look at this financial stress, and if it gets on towards 40%, I get worried. Below that, I'm significantly less worried. And that's the first 4 that I got asked to do. I've got another 1, 2, 3, 4, 5 to do, which I'll do shortly. But let me have a little go here and just see what's going on. And then we'll come back and see what else we're going to talk about. Let me put that on there for a moment, just to give everybody a bit of a rest. Okay, a lot of stuff in the chat which I haven't really got through to. Okay, so okay, have we got the question? Yes, we have. So the question is running. That's good. That's good. I didn't have a chance to see whether a Smooth Operator posted it, but I think he did. So that's great. And watching the various Vanessa asked this question: is it better to live in Tapping or Mandurah? Well, judging by what I'm seeing in the data, I think Mandurah is still one to be a little bit cautious of. Not only are the social issues probably worse than in Tapping, but the price falls have been most significant. On the other hand, you might be able to pick up a real bargain because there are lots of people struggling there to work out what to do. Probably investors definitely struggling with some of that. James says, and he's quite right, probably will be a liability if the government goes broke and tax creep becomes worse. Yeah, tax creep, I think we've got to be careful on this because, Victoria actually started putting taxes up, particularly for some businesses, right, before the last lockdown. That's an early harbinger of what's going to happen. Somehow they're going to have to work out how to repay this at some point. Now, of course, everybody says, well, hang on a moment, MMT says you never have to repay it. Well, my view would be well, eventually you will have to repay it in some way. It's just a matter of when and how. So, now AI made this an interesting point. I wouldn't consider the affluent to be financially stressed as they adjust their budgets if they really wanted to. Do you agree or disagree? No, I don't agree. A lot of the affluent people are really stressed because they don't have cash flow, right? So sure, they've got assets. They could sell property and those sorts of things. But on a cash flow basis, they actually fit my definition of being stressed. Now, the stress that they've got is manageable because they can sell property or they can do things, right? Whereas those on the outer suburban ring, perhaps younger people, first-time buyers, they have no wriggle room at all. So they may have a chance to get out of jail. But remember, I'm measuring stress, not default, right? I'm measuring financial pressure on households, not default scenarios. So that's why it's relevant and appropriate to talk about those more affluent households. Okay, so Smooth Operator, have I got the question? I think I probably have there. That's the question. Name this famous town. So it's all about naming the town. The MTV video of the song Never As Good As the First Time shows Sade riding a black stallion into a strange town which could be mistaken for a set from a Clint Eastwood movie. Name this famous town. All right, so that's the question that was posed. And we're just up in a second to 9 o'clock, so we'll assume a number of people have put their answers up, and at 9 o'clock we'll close out that question. But there you go, that's the one. And now, Cross Stitch Ange says, interested in 4065. 4065, yeah, we can do that. Hang on a moment. Let me just go here first. Okay, 4065, so I'm just going to switch back to there and get rid of that so you can see it. So this is 4065, this is Baden. 3663 households, 1,600 borrowing, 1,200 renting, 42% in financial stress. There are 18% in mortgage stress, that's pretty low, that's pretty good, and rental stress is at 38%. So there's more rental stress than mortgage stress. Property investors therefore having a bit more of an issue than the mortgage holders, and that's because of this issue of getting people who can pay rent and the cost of investment property. Overall, over 3 years, we're looking at a rise of, best case, about 13% for houses and about 9.8% for units. On the other hand, a fall of 4.6 or 3.4 respectively if things go really pear-shaped. So there you go, that's that one. Okay, what else have we got? Okay. I love some of the debate about the question. So I'll leave everybody to... James said, I see a UFO on the stress map. Could well be. Who knows? Yeah, amazing what you see. Logan made the point that there are some ethnic roots in some of those. That's one of the things I do actually highlight in my analysis, what I call my first generation migrants to Australia. A lot of them are in those high growth corridors. A lot of them are actually overcommitted on mortgages. They actually have a significant issues with regard to maintaining those mortgages, and of course quite often what happens is the whole issue of maintaining employment to be able to make the mortgages work is what's driving a lot of the behaviour in that area. So I agree with you. Okay. KNG says, you've been saying a housing crash since 2011 when Sydney median prices were 250k. Today it's 1.2 million. Yep. Well, you know, you've got to understand, again, I have always used scenarios. I've always had the different outcomes. So just saying broadly as you do, housing crash is not actually fairly representing what I've said at any point, at any time. All I'm saying is be cautious, be careful, because you can easily get in over your head, and you know, given where we are with high levels of debt, etc., people should be cautious. But you need to understand my scenarios, not just read the headline from newspapers who decide to take a particular line and don't give it fair, accurate representation of what I really say. Vincent says, with the end of JobKeeper and JobSeeker, mortgage and rental returns, are your thoughts on the future of the economy? Yeah, there is a very interesting thing going on, Vincent, as you rightly say. Of course, the external factor of commodities, the latest trade data that came out today highlighted that the trade gap was very good, very positive, and that's because of iron ore, basically. Iron ore price is down a bit, but still very strong. If China were to turn off iron ore, that would be a big issue for us. But if that doesn't happen, then the economic domino of the resources sector will continue. The question is that going to be sufficient to maintain the rest of the economy? And that's my point from earlier on about unless businesses start investing in things, unless we actually start seeing the momentum in the broader economy, that's going to be a big deal. So what I want to say is that the end of JobKeeper and JobSeeker is a big deal. We are seeing a number of households able to get back to work and do their things. But of course, then we've got the lockdown. And so the lockdown has the potential to turn some people back into financial difficulty again. And remember what I said, the overall level of financial stress has gone up from 32% before the crisis to 41% now. It's not coming down yet. So people are very vulnerable and exposed when interest rates are very, very low. So there's the risk that I see is that a lot could actually change and create a lot of pressure for a lot of households. Now, maybe it won't. Maybe we'll be all right. But I don't think it's as simple as saying we'll be fine because of commodities. I think it's a lot more complicated than that. Okay, here's another postcode. Can you bring up 2200? Sure can. Okay. 2200. Whoops. 22. I typed too fast, then I have to retype it. Dear, oh dear. It's all great fun, isn't it? Okay, here we go. Let me get rid of that so you can see it. Okay, so this is 2200. So this is Bankstown, Condell Park. 14,800 households, 4,600 borrowing, 7,900 renting. So a lot of renting going on there. More than rental property owners, 4,000 and 6,000 properties for rent. 58% in rental stress. So that's quite high. And financial stress, 58, that's quite high. Anything above 40, as I said, is alerting. Within that, though, it's not mortgages. So mortgages are okay. 26% in mortgage stress, 1,100. It's renting. 77% of people in rental stress at 6,000. And property investors, 40% of property investors are in difficulty, 1,300 stressed, of which 285 are severely stressed. Now, the severely stressed ones are the ones being forced to sell, and that's because the cash flow issues on their rental property are impossible to solve. Nevertheless, we're looking at a price rise over 3 years of 7%, good best case, or down 11% worst case for houses, or up 5% for units, or down 8% for units. So you can see there the different scenarios that we actually run. So there you go. Hope that's useful. Okay, what else have we got? Okay. Junk Bonds makes the point. Thank you. 343 watching. Well, it's actually 347 now, but there you go. 128 likes. Folks, please like the show. If you've spent some time with me tonight, do please take the time just to click that little like button. Not really that hard to do, is it? It really does make a difference, so please do that. Okay. Logan says landlord in Victoria need a good lesson. They're having the lesson. Many landlords are really, really struggling. So if you talk to landlords of apartments, those who bought perhaps several apartments a few years ago, they are really up against it. Now, of course, there's still a lot of new construction going on in both Victoria and New South Wales. Remember those building approval numbers I shared earlier on? One of the interesting things is that the momentum for units in Victoria has fallen through the floor. So a lot of people not building new stuff. There's a lot of old stuff still available for rent. And if you go into places like Docklands and around there, of course, that would have been perhaps student accommodation previously. Well, the students didn't come back. Go out towards Monash, a lot down there as well. A lot of people are learning the lesson the hard way. And remember, I've showed some data the other month about the number of investment properties in negative cash flow, more than half in Victoria. Okay. Thank you, AI. I appreciate that and your answer, so that'll be good. We'll know very soon when I get to it whether that was the right answer or not. Okay. Thank you very much. Yeah. What is acceptable stress level, says TB? Interesting question. So what I basically say is that, you know, there will always be some people who will have some difficulties, and, you know, the likelihood is stress could be perhaps short term and, you know, you can get out of it. But what I find quite often is that once people have a level of stress for a few months, unless they change their behaviour, it never actually sorts itself out. And if you start seeing multiple levels of stress in the same area, it tends to have a very significant negative drag on prices, rents, sales, and all those sorts of things. So once you see a level of 40% and above, that's a real warning in my model. And quite often what I see in the warning signs is early stress levels. Later on, it often translates to defaults. And, you know, Mandra is the old classic case that I keep coming back to because I've been watching that one very closely for a long time in WA, right? And we started seeing the stress rise, then we started seeing the defaults rise, then we started seeing the prices fall down 30%. They've come back a little bit, but there are still many property investors over there who are really struggling. So essentially, that 40% level is a really important threshold. James, thank you very much. Appreciate that. Okay. What else have we got? Okay. Lots of interesting questions. A cheap beer from Victoria. Can't get on the beers. Hopefully Thursday is not bad news, but we are resilient. We'll get through it. Stay strong. Stay safe. Yep, very good point. Yep. Absolutely. Hang in there. Hang in there. Okay. Now, let me go back and do a few more postcodes. I've got lots on my list from earlier on. And I've got, I did promise to do all of those that asked. Okay, so 2750 from NA. 2750. Look up. Okay, so this is 2750, the area around Emu Plains and Penrith. 18,300 households, 7,000 borrowing, 8,000 renting, 6,000 rent, and about 4,000 property rental owners. 40%, so yeah, you're on the threshold there, 40%. And 3,000 mild mortgage stress, 44% in mortgage stress. That's quite high. 1% defaults, it's around 99. 46% in rental stress, 3,700. 24% of investors stressed, about 450. And in terms of price rises, we're seeing about 8.4% over 3 years in that particular postcode. Best case. Worst case down about 9.9. For units, best case about 6%. Worst case about 7%. So that gives you a bit of a flavour. This is a threshold level, as I've mentioned before, 40%, 44%. Mortgage stress is an issue. Rental stress is an issue. So far, the investors seem to be getting away relatively scot-free, but we'll see how long that goes on for. So that's that one. And I've got another one then to go to do, and that was postcode 3145. 3145. Okay. 3145, look it up. Off we go again. So 3145 is Malvern East and places like that, Caulfield East. 9,500 there with households, 3,200 borrowing, 4,100 renting, 3,100 properties for rent, 4,100 rental property owners, and 39% in financial stress. Mild mortgage stress is 596. Severe stress, 237. Now, I just want to underscore, severe stress means they're severely underwater. We're seeing quite a lot of that in and around Melbourne at the moment, not least because of the lockdowns. 26% in mortgage stress, not very high. 4% in default. Rental stress, 26. Property investors, 47%. And again, property investors begin to struggle, and that's coming through in some of those. 108 in severe stress. In terms of price movements, 9%, highest for houses over 3 years, down 8% over 3 years in the bearish case. For units, not so high, 6.9% and minus 6%. That's that one. And what else have we got? Let's have a look. A lot more conversations going on there. Plenty happening in the chat. I'd like to see that. Daniel asks for 2050. Sure thing. Can do that. Let's just get myself there. 20. You can do this for yourself if you sign up for the Patreon. You can then go in and do your own analysis and do the cross comparisons of different areas too. But anyway, let me just show you this. This is the 2050. So 5,400 households, 1,200 borrowing, 3,900 renting, 2,900 for rent, and 2,600 property investors in the area. 78% in financial stress. That's a really big number. I think that's the biggest we've seen so far. So Camperdown is an issue. In terms of mortgage stress, not a lot going on. Default rate's quite low, but it's all in the investment sector. 71% of renters, 2,788 struggling. And look at this, property investors, 79%, 1,396 stressed investors, of which 698 are severely stressed. So it's the investment sector that's really struggling at the moment there. And some of that, I think you'll find, will be because we're not seeing the students coming back, and you know, the education sector would have been quite strong in this area. So a lot of rental property is vacant, and we're also seeing quite a few people who just don't have the hours. You know, they're working temporary jobs to try and pay the rent. So that's one of the reasons why this area is significantly at risk at 78%. That's a big number. Overall, houses up 6.8% over 3 years. Best case, worst case down 11%. 5% for units, and down 8.4% if you take the worst case scenario. So that's that one. And I'll take that off for a second, see what else we've got. Okay, now Jack asks for Tralarogon, I think that's called. I love some of these names. It's a great way of getting to know more about Australia and all the different locations there are, doing this. So that's 3844. Okay. Pick it up. 3844. 12,900 households, 5,400 borrowing, 5,200 renting, 4,000 properties for rent, and 3,400 rental owners. 43% in financial stress, 3,906 in mild stress, 72% big stress, big mortgage stress in the area, 3% defaults, 146. Rental stress, 24%, not so bad. Investor stress, only 13%, not too bad. So this is a mortgage stress suburb. This will be people perhaps bought relatively recently, exposed now, and it's quite often the case that it takes a little while for this to work through, but nevertheless, that's not good news. Overall price rises, 9% over 3 years in my bullish case, down 8% in my bearish case for houses, units up 6% and down 6%. So that's the story there. Can I do postcode? Whoops. I got too many Mises on the table. Hang on. There we go. 2008. Yeah, sure can. And just to explain, I've had a few experiments with different types of Mises setups and different buttons, and I found that having different Mises on the different computers is the is the best way to do it. Otherwise, it gets very confusing when I keep pushing buttons and switch from one to the other. I've tried a KVM and things; it just doesn't work. So that's just where we are. Okay, so this is 2008. That's Chippendale and Darlington. 5,600 in stress. Borrowing 822. Renting 4,500. Properties for rent 3,400. Property investors 2,100. 78% in financial stress. Big number. But within that, it's not mortgage stress that's the problem here. Pretty good. Defaults are pretty low. It's rental stress and property investor stress. So we're seeing quite a few people with rentals struggling, and we're seeing property investors just not getting the returns they need to be able to make the returns. And I guess if you think about it, again, it's quite close into places like Redfern and Chinatown. So again, it would be very much student-based, very much the education sector that would be actually feeding that. So maybe not surprising. A lot of people are trying to sell in the area. One of the reasons why the projections with regard to prices is only 6% up over 3 years for houses, down 11% worst case. For units, up 5% or down 8%, depending on the scenario that you play. So that's that one. And a lot of these close-in suburbs, when you start looking at them closely, you realise that close into the city centres, a lot of them are really, really struggling. And I think we're going to see more of that ahead as well. Okay, can I do 0820? I'll give it a go. 0820. Whoops. 0820. Should. Okay, 820. Go. Look up. There you go. So this is one of the yeah. Okay. Northern Territory, 9,300 households, 2,000 borrowing, 6,400 renting, 4,900 properties for rent, 1,700 investment owners, 21% in financial stress. It's pretty low. Mortgage stress is 28% or 602. Rental stress is 16% or 1,031. Investor stress at 21% or 360. So not a huge sort of set of issues there at the moment. Growth around 10% over the next 3 years for houses. Best case, down 8%. Worst case, for units, up 6.8%. down 6.1%. Not that many units, I suspect, there up in the area, but that should give you a bit of flavour. I've tried to do units and houses where I can, just to give people a relative comparison. Well, we're at 9:19 already. Can you believe it? I don't know what happened. I've got a few more postcodes to do. 3109. And I've also got the ones from earlier on, so we'll try and get to them. 3109, the Pines, etc. Okay, here we go. 11,000. Push that. There you go. 11,029. 3,956 borrowing. 3,700 renting. 2,800 properties for rent. 3,700 rental property owners, 39% in financial stress, 36% in mortgage stress at 1,413, 52% in rental stress at 1,936, 28% in investor stress, 985 with 60 in severe stress. So again, it's renters that really is the action point there. And over the next 3 years, more than 9% up is likely in my best case, down 9% worst case. For units, up 6.8% or down 6.9%. It's interesting how symmetric those things have become. Depends on the outcomes, of course, that we look at. So there you go, that's that one. Let's go back to there. Logan makes the point, which is quite a good one. When they set the USA loose, watch the inflation go bang. Yeah, well, there's a big debate. Is inflation strategic or is it just tactical? Is it sort of short-term transitory? Watch this space. We'll know soon. The stuff in the US, more people are beginning to say, well, maybe it is transitory, but we'll see. And certainly the bond rates are suggesting it's more than transitory, but we'll see. Okay, here we go. Another one, 2607. Bung that in there. 2607. Here we go in the ACT. Let's just make sure that comes up so you can see it. Get rid of that. Okay, so this is 2607 in the ACT, 5,800. Households, 2,100 borrowing, 2,200 renting, 1,600 properties for rent, and number of rental property owners, 2,300, 27% in financial stress, 24% in mortgage stress, 497, 18% in rental stress at 390, 31% in investor stress, with 36 in severe stress and 679 just in stress. A bit of selling pressure there for some investors. Overall, 10% over 3 years is quite likely. A fall of 8% worst case for houses. Not as much for units, 7.5 or down 6%. So that's that one. Okay, another one here we'll do, and then I'll come back and do the ones that I took at the beginning of the show and make sure I cover those. 4556. 4556. Okay. So here we have Sippy Downs and places like that. 17,400 households, 7,000 borrowing, 7,000 renting, 5,200 properties for rent, 6,100 rental property owners, 35% overall financial stress. Mortgage stress is 36%, 2,499, 3% default rate at 313. Rental stress 28% at 1,952, and investor stress at 28% too. Interesting, 1,673. Price rises 14.7% over 3 years. Best case for houses, worst case down 3.7%. For units, up 10% or down 2.7%. So more upside than downside in the Queensland area that we're looking at there. Of course, it's just in land from the Sunshine Coast, and I've done a few shows at some of the areas in and around there, so look on the website if you want more information about some of those. Okay, let me just go back to do these other ones that I said I would do. 3036, let's put that in there. So these are the ones I picked up from the chat before we started. I like to keep my promises when I can. Okay, Kilo. Okay, here we go. There's Kilo. And in Kilo, 2,300 households, 965 borrowing, 603 renting, 467 properties for rent, 1,300 rental properties, 34% in financial stress. The mortgage stress is 50% at 483, that's quite high, 3% defaults. Not really much rental stress happening, 24% of property investors struggling. One of the things I'd highlight is there's plenty of stuff there available. I think that's probably part of the reason for that story. And overall, 11% rise for houses, best case. Worst case, down 7.7%. For units, up 7.7% and down 5.5%. Done 820, that was also asked for, and then I'll do 3844. Okay, make sure that we get that one, 3844. So that's places like Flynn, for example, 12,978, of which 5,400 are borrowing, 5,200 are renting, 4,000 properties for rent, 3,245 rental property owners at 43%, 72% in mortgage stress, that's a big number, 3,906, 3% default rates, 146, 24% rental stress at 1,225, and 13%, or 252, investors. So this is a mortgage stress story. Overall 9% rise in houses over 3 years, compared with a fall of 8.9% in the worst case scenario. Units up 6.6 or down 6.5. Okay, so that's the ones I got beforehand. We're running out of time fast. Let me just quickly run down here. What else haven't I got? Did I do that one? 3145. I don't know. Did I do 3145? Yes, I did. So I did that one earlier on, I think. Yeah, I did Malvern East earlier on. So, yeah. That one. Fridge in the fridge. 3042. 3042. Can do. 3042. Oh, come on. 3402. 3042. Would help if I could type, wouldn't it? Keller Park, Airport West, yeah. 6,986 households. Let's get rid of that so you can see it. There you go. 2,500 borrowing, 2,400 renting, 1,900 properties for rent, 1,700 investment property owners, 49% in financial stress, 62% in mortgage stress at 1,570, 3% default rates, 57% in rental stress at 1,413, 24% in investor stress, 49% severely stressed, 369 in total. So, bit of an issue that one. Overall price rises for houses 8% over 3 years, best case down 10%, worst case. Units up 6%, down 7.5% over 3 years. Okay. One Burjo. Hello. 4551. Can try that. 4551. Okay, I'll look up. So this is Queensland postcode 4551, Caloundra, places like that, Little Mountain, Moffat Beach, 26,665. 8,300 borrowing, 12,200 renting, 9,100 properties for rent, 9,800 rental property owners, 45% financial stress. Mortgage stress is 33%, 2,772, 3% default rates, 242. Rental stress, 49%, 5,959, going up. I can tell you that's a significant issue there. And investor stress, 36%, 3,185. Of which severe stress, 332. And in my projections, up 13.6% over 3 years. Best case scenario for houses. Worst case, down 4.8%. For units, best case 10%. Down, worst case, minus 3.5%. So there you go. Hope I've saved your life. Okay, here's another one. 2135. Did I do that one before? I'm not sure. I get to the point where I've done so many that I sort of lose count of whether I've done it, but I'll just put it back in and see what happens if I recognise it. 2, 1, 3, 5. Strathfield. No, it's a new one, I think. Strathfield. Yep. Good question. Very interesting. Inner city, suburban one. So 8,854 households, 2,300 borrowing, 4,599 renting, 3,400 properties for rent. Number of rental property owners, 3,200. 50% in financial stress, 28% in mortgage stress, 4% in default, 50% in rental stress, 2,300, 57% in investor stress. So you can see across the board there, it's on the rental and investor side more than the owner-occupied side, but 28% is, not insubstantial. And if you look at that, overall 7.5% growth over 3 years is my best case for houses, down 10%. For units, up 5.6% or down 7.8% for worst case. Okay. I'm getting to the point where I'm going to run out of smoke quite soon. In fact, what I'm going to do is I'm just going to come back and just close out the rest of the show, and then I'll pick up the last few postcodes if I can before I finally go off air. It's just that we are now running up against the deadline, and I don't want to keep people hanging on longer than promised. Whoops, push the wrong button. That's not going to help anybody. Let's go there. Okay, so just on the tool. So that tool is available if you sign up on Patreon, $50 a month. You can make comparisons between postcodes. You can make comparisons at state level, location level, SA2, SA3, as well as the postcode level. A lot of other information there, and other information's coming. So, for example, net rental yield will be in the model quite soon, and I've got other data coming through. So this is an ongoing evolution of the tool, and I'd be interested to get more feedback as well in terms of what may be happening later. So with that, let me just trip through to the end of the slides here and just go up to the, whoops, where's that? Here we go. Okay, so that's the Q&A done. In terms of more information, walktheworld.com.au if you want to go there to get more information about what we do, and also, of course, our funds powered by Nucleus Wealth. There's also the DFA blog if you want more information. You can also contact me via the DFA blog using the tool there. And if you've got a postcode that you want information for, send me a message via the DFA blog and I'll try and turn that around in 2 or 3 days. Details there. You can support our work on Patreon, and there are different tiers that are available there. This is quoted in US dollars. Depending on your setup, you might see the Aussie dollar alternative. And the $50 a month US is actually where you get all this information. So all of the data that I've showed tonight is available and sent out, accessible. And those people who have on that tier at the moment have access credentials to get into the tool, manipulate it themselves, just like I was doing, and can make a lot of comparisons. You can download the data, you can manipulate the data. So that's how you get the full information set, more than 2,000 postcodes in the data set. And as I say, more information coming shortly. You can support us by Bitcoin if you like. That's the QR code. A few people have done that. Always appreciated. And there's also a merch, as I always say, just in case you want to support us that way. Now, in terms of next time, there is a interesting conversation to be had with Adam Stokes, who's very much into crypto. We had him on a few months ago when, of course, crypto was booming. I want to have him back on, and I'm going to discuss with him next week Beyond Crypto with Adam Stokes. What happens now? So that will be an interesting show. So mark your diary and come and join us for a crypto extravaganza next week. Who knows whether Bitcoin will be at 30,000, 40,000, 50,000. And what about those other coins as well? Where are they going to be? So that'll be an interesting conversation. And I think it will be a very fascinating show, because I want to take the conversation further in terms of can you be your own bank, for example? You know, do you need banks anymore? Are banks obsolete? All those things as well. So that will be part of the conversation on next week's show. So I look forward to seeing you then. And now let's just quickly go back, and anybody who wants to drop off, you've heard the main part of the show now, so thank you for your time with us tonight. Pretty appreciated it. I will just do a few more postcodes for those who ask, simply because I appreciate people coming on and basically asking for my help, and I'm very happy to try and give it the best I can. But as I say, if in fact you are unable to hang around, you can always send me a message on the DFA blog, and I will then send you the same snapshot of information as I've been sharing. Okay, Anthony asked for 3079, so let's do that. 3079. There you go. Let's just put that in there. Get rid of that so you can see it. Okay, so this is Ivanhoe East, 6,700 households, 2,300 borrowing, 2,600 renting, 2,000 also properties for rent, and 1,300 rental property owners, 47%. 91% in mortgage stress. Ooh, that's pretty high, 2,178. 30% in rental stress at 823, and 13% in investor stress. So it's a mortgage stress story. We're seeing that, of course, in a lot of those outer areas around Heidelberg and places like that as well. So it's quite consistent. House price projections, 8.5% over 3 years. Best case, down 10%. Worst case, units up 6%, down 7.2%. And as I always say, could change again. You know, that's just a bit of a snapshot, but that's how I see it at the moment. And then another one question here, 6210. I can put that one in. 6210. Look it up. Okay, that didn't work. I'm getting a bit tired. 6210. Pick it up. Look it up. Yeah. Okay. So this is places like Falcon, and One Up in Western Australia. 35,104 households. 11,600 borrowing. 17,600 renting. So renting is pretty much a thing over there. 13,000 or so properties for rent. 11,000 investors. 32% in financial stress, 70% in mortgage stress, 1,940, 34% in rental stress at 5,971, and 30% in investor stress with 113 severely stressed. 10% rise over 3 years expected, best case, down 7.7%, worst case for houses, down up 7.5% for units, down 5.7% for units, worst case. Okay, so there you go. Zach asked for one. 7173. 7173. 7173. Okay, Carlton. This is like Carlton, places like that. In Tassie. Going to get rid of the chat so you can see it. 3,691 households, 1,555 borrowing, 1,667 are renting, 1,276 properties for rent, 627 property investors at 55% in financial stress. That's quite high. Rental stress at 35% or 480. Investor stress at 25%, 442 and 12. But mortgage stress 83%. 1,296, and 2% of defaults. Mortgage stress in Tasmania is very high. In fact, it's the highest over the country, so as a proportion. Prices 7.2% higher over 3 years is my best case. Down 11% worst case. For units, it's 5 up or 8.3 down based on the scenario. And we'll do one more. This is from Ryan. Oops, let's get in there, put that in there. So 6025, 6025. Padbury and places like that. Western Australia, 12,227 households, 6,216 borrowings, 3,500 renting, 2,700 properties for rent, 3,600 rental property owners, and 34% in financial stress, not too bad, 31% in mortgage stress at 1,954, 4% default rate, a bit higher than some areas, 38% in rental stress, 1,337, 25% of investors in difficulty, with 62 of those in severe stress, and price 9.9% highest over 3 years, down 8.4% lowest. For units, up 7.3, down 6.2. There you go. Yeah, how many more have I got? I think I'm going to have to call it a night. So those of you who weren't able to get my answer up tonight, one more. 3754. I know. 3754. Okay. Please like the post, guys. Please like the post. It's really, really important that you do that as I do this. This is Doreen, Victoria, 13,300 households in there, 9,100 borrowing, 4,500 renting, 3,400 renting properties, and 2,500 investment owners, 68% financial stress, quite high, 57% mortgage stress, 5,279, 3% defaults, rental stress, 75%, 2,422, 3,422, 17% in investor stress. So rental stress, very high, and mortgage stress, pretty high. 7.8% over 3 years is my best case for houses, or down 10% worst case. 5.6 higher, 36 months for units, down 8%. Donna asked the question, very interesting question. Thank you, Donna, for that question. Does it mean more houses are likely to come on the market? Yeah. Where you've got high levels of stress, it's almost always the case that it's going to put extra imperative on people to list. At the moment, some property investors are there at the moment. So in my surveys, particularly property investors with units that are struggling to let them, are thinking of trying to sell into the rising market, although units rising market is a bit of a question, right? We know that some mortgage holders are also in difficulty because they've no longer got the government support and the bank support, so they're having to make their mortgage repayments. That's why mortgage stress is rising, as I showed you earlier on. We're going to see some more of those coming on later in the year. My expectation will be that we will have more listings coming on, forced listings, which means that potentially prices won't be as strong, which means that essentially that might be the turning point in terms of prices. We'll see. Well, I want to help everyone. I do want to help everyone, but unfortunately I've run out of smoke. I turned into a pumpkin at 9:45. So, look, I think we're done. So I thank you very much for all of your comments. I don't know what happened with regard to the question. I'll look back over the stream, assuming somebody got it right. I'll go through and pull out those who got it right, and I'll announce tomorrow who's got the opportunity to have a free conversation with me on a particular suburb, basically going through this data in more detail and also the other stuff. If you want to have a one-on-one conversation more generally, always open to it. As I say, I'm booking quite far ahead at the moment because there are so many people that essentially are wanting it. So there we go. And thank you very much. Have a good night. Thanks, Logan. Thank you, No Trigger. That's good. Appreciate that. Please do like the post on the way out. Okay. And Smooth Operator just gave, there you go, 3 or 4 people there came up with some of the right answer. So we'll thank you very much for making my life easier, Smooth Operator. We'll run a bit of a random I'll do a random generator and we'll produce an answer, and keep up that. Thank you very much, Smooth Operator, for the question. That was good. Thanks, Will. Appreciate that. Let the dogs take over. Okay, fair enough. Yeah. Dogs are quietly asleep now. Zach says, Cookie Boy, when's your show with me? Good question. And thank you, Not. Appreciate that. Glad it helps. I'm trying just to provide, perspective and to help people make better decisions. That's what we're here. So I hope you found it useful tonight. I want to say thank you very much for your spending time with me on the show tonight. Thank you very much for all those who made a contribution via the Smart Chat, for those of you who participated in the chat, and for those of you who asked questions. And hopefully I was able to provide some answers. As I said earlier on, next week, of course, we'll be talking crypto, so that'll be fun. I look forward to seeing you there. And have a safe evening for those people in Melbourne. I hope very much that you stay safe, and that the lockdown comes to an end very soon. And for those in the other states, stay safe as well, and keep well. And I'll look forward to seeing you same time, same station next week. This is Martin North from Digital Finance Analytics, signing off. Cheerio.